What is going on, investors? Welcome to my channel. This is Jason, aka the Frugal Investor. Today, I have reached a personal goal of mine, and through my journey, I have learned a lot of things. I've done a lot of mistakes, and I've learned a lot of things. And through the means of this channel and through the means of this video, I want to share my journey and my mistakes along the way so that someone who is also trying to achieve financial freedom, or someone who's already achieved it, or someone who's on the way, they can pick up some nuggets from what I'm going to tell, what mistakes I made through my journey. And that is my mission for this channel and this portfolio. My mission for this portfolio is to achieve financial freedom, to help me achieve financial freedom where I do not have to rely on active income, but I can live off of from the income of this portfolio. And when I can live off of from the income of this portfolio, I am free to pursue passions of my choice. For example, investing, for example, stock picking or reading books, making videos. These are some of my passions, and I don't want to depend on an active income to pursue these passions, but I would just want to have a income stream which this portfolio will provide me on which I would be able to comfortably live a good life and also pursue my passions. And until I monetize them, I don't have to worry about money because this portfolio will provide me enough passive income to live off of. And I don't have to worry about that. That is financial freedom for me, and that is what I'm trying to achieve through this portfolio. And I want to share my journey. Every goal I reached a goal of 100K, now I reached a goal of 200K. Every goal I reach, I share it on my channel, my mistakes, my successes along my journey so that I can help someone else who is also on their journey to financial independence or financial freedom. The main goal is freedom of our time, freedom to do what we want with our time with whoever we want. We don't have to be on the clock for some other company or someone else. We can be where we want, when we want, and we can do what we want on our time and on our buck. That is the main goal, and this portfolio is going to help me achieve that. Now, this portfolio I started in back in November 11, 2020, so it's only barely 10 or 11 months old. So far, my returns from this portfolio are up almost 24%, and my goal, my mission, my goal, whatever you want to call it, my goal for this portfolio is to achieve an annual return of 20 to 25%. Now, how do I plan on doing that? Well, first of all, I plan on buying great companies, great businesses at great prices. By great prices, I mean when times are bad, when there is blood on the street. At those times, I build up big positions into good businesses. That is my main strategy. The second strategy is, along with that, I'm also starting to pick stocks that I think will 10x or 20x in the future. For example, Medifast. Companies like Medifast, which I think will 5x or 6x in the future based on their earnings, the way they are growing. So that is how I'm planning to make a return of 20 to 25% from my portfolio, along with dividends. Now, so far from this portfolio, I have earned about $2,265 in dividends over the past 10 or 11 months. So I would say that is about $220 a month on an average from a portfolio of 200,000. Now, I am not that focused on dividend because my portfolio is equally divided in growth, value, and dividend stocks. So more focus was on growth, but now I've started to equally distribute it among value and dividend. I sold some of my Tesla positions at around 870. I bought them around 600. That position I have used to buy companies like Medifast, buy companies like USANA, buy companies like Kimball Electronics. Now these are all small cap companies, value plays available at low P by E ratios. They have good book value, tangible book value. So if the market falls or if anything else happens, I know that my money will be safe because that money is in their assets as well. If they liquefy their assets, I will be easily able to get my money back, at least in some cases. So those are the plays that I'm trying to make more now. Now that I've reached this goal in my portfolio, my growth pie, which is the technology pie, most of my growth holdings are in the technology pie, which is up by almost 26% so far. And this pie, I'm not really adding any money to it. Now, this pie, it contains all the technology companies like Google, Apple, Facebook, Etsy, Broadcom, PayPal, Shopify, Alibaba. And some of these, like Shopify, is up by 50%. And the reason it is up by 50% is because of the time that I bought it at. Google is up by almost 46% because of the time I bought it at. Same thing with Etsy, which is up by almost 32%. Broadcom is up by almost 32%. Now, this is because of the time I bought it at. Alibaba is up by almost 14%, and I think Alibaba will triple. This position for me in the future, it will triple or quadruple. And I bought it at a time of maximum pessimism when the stock was trading below $140 just in the past month or month before that. The stock was trading below $140. That's when I was picking it up. There was extreme pessimism around Alibaba. There is extreme pessimism around Facebook. On Facebook, I'm up by almost 17%. There is extreme pessimism around Facebook. So these are my times to build a position into businesses like this, and then I hold them. And then I hold them and gain the rewards because these are good businesses. I keep an eye on the storyline. Okay, what is going on with the company? Are they still making money? Are they still profitable? As long as the basic storyline, the bottom line of the company is strong and growing, everything else is okay. News come and go, but I know these businesses will be growing. I know they're great businesses, and I know I'm their owner, so I know they will be growing and doing good. Now, some companies like PayPal and Shopify and Broadcom, I know I have to harvest my returns. I know I have to take some money out, take some of those gains and put it somewhere else in more value plays, which I think will 2x or 3x in the future. That is what I am trying to do, and that is what I'm going to do in the future. And I am going to sell some of my holdings like Shopify and PayPal, not all of them, but some of the gains I will take and I will put it in other value companies. Now, the reason I'm not going to sell Google, Apple, or any other company like that, but I'm going to sell some of Shopify and PayPal. Now, the reason I'm going to do that is because of their valuations. Their valuations are so high. I mean, sometimes Shopify is trading at a P by E of 300 or even over 300. And I will give it another 2 3 years, but if within the next 2 3 years, at least I want a P by E of 40 to 50 for Shopify. If it cannot do that, then I think we are in the red. And if any bad thing happens in the market, or the market goes in a bear mode, or technology sector gets beaten down or something, I think Shopify can have a bad time because the stock is so high valued. I mean, it's unpredictable. It's like um, I can't tell. I don't know. I don't know. Basically, I don't know why I'm paying so high money for it. And I've taken my gains because I bought it at such a good time. So I will be taking some money out of it and putting it somewhere else, just like I did with Tesla. Now, I am trying to avoid too many high P by E ratio companies in my portfolio because I don't know where the value is coming from. I don't see how they can reach how they can reach a P by E of 300 in the next 5 years and 6 years. If I talk about value, based on that concept, based on the concept of value, based on the concept of tangible book value and discounted cash flow, based on that concept, I just can't wrap my head around it. If I talk about, like, okay, yeah, yeah, next 10 years, if I just say next 10 years it'll be big, Tesla will be big, or Shopify will they're doing this, they'll be doing that. It is easier to say that way. It is easier to hypothesize it that way, so to say. But it is so hard to actually put my head around it. And if I can't put my head around it, then I have to let it go. And that was the reason I let go of Tesla, because I just can't put my head around the high P by E ratio. I just can't put my head around, okay, I have to wait 300 years to break a buck to get my money back. I mean, there is enthusiasm which will push the share price up, but doesn't that make me a speculator then? So that is the reason I'm trying to, keep my positions to value companies itself, companies that are bought at great prices like Google, Apple, Facebook, um, Alibaba, companies like this. Everything else is just pure speculation. So companies like these four companies, Google, Apple, Facebook, and Alibaba, everything else I might be liquidating slowly by slowly after I take my gains. Almost all of them are almost up by 50%, 32%, 21%. So I might be taking those gains and investing it into value companies, companies like Kimball Electronics, companies like New Skin Enterprises, companies like Aero Financial, companies like Medifast, companies like USANA. Now I know these are not cool and hot stocks, and these are not stocks uh, that will like create a ruckus on the street because they're so famous and they're so upcoming and they're so booming. But these are great businesses. I've read their 10Ks, I've read their 10Qs, I've done my research. These are solid businesses. and they are growing. They're not growing like Google and Apple, but trust me, they're growing. I mean, Medifast is growing fast. Medifast is growing by almost 25 to 30% a year. So Medifast, I'm expecting my money to double within the next 2 3 years. Kimball Electronics, it's a slow grower, but it is a grower nonetheless. And I'm expecting my money to almost quadruple or even 5x based on the earnings. Now, I'm not saying the stock price will quadruple or 5x. I don't know about the stock price. Stock price is based on market euphoria, on human behavior, and I really can't predict that. But I can predict the earnings based on the earnings in the future past, based on the context that they are taking up in the future, based on the earnings that are coming in the future, based on what I've read in their 10Ks and listened on the calls. Based on that, I can tell that their earnings will compound at least 5x or 6x as to what they are today. And so that is why I am picking up companies like this, because I know their earnings will compound. And also, the other main reason is their cheap price. Right now, they're available at P by E of 10, 12, 13. Medifast available at a P by E of 12, and the product is fantastic. People love their products. 44,000 coaches all across the country. Okay, 44,000 coaches, and now they're expanding in Singapore and Hong Kong, and their product is amazing. People love, the customers love their product. The management is good. They want to grow. They want to do good. Their earnings, it was $6. Now it's $8. The next year it will be $12. Next year after that it will be $16. And if I reflect that in the stock price, my money is double. I bought it at $8 a share when it was making $8 a share. Earnings per share was $8. Okay, and if it goes to 16, I double my money. I double my money. My earnings per share they have gone up. Plus they have low debt. Okay, they have low debt. They have good book value of 17 $18. Now stock price is almost $200, $190, and the book value is so low. So I mean, it's quite low, but the earnings are more than enough to support that, price. The earnings and the love for the product, the expanding market, the 44,000 coaches that are their personal salesmen. Now these salesmen, they were customers before. They have experienced change in their bodies through Optavia, which is their product, and now they have decided to become salesmen for other people. So these 44,000 people, they are like soldiers on the front line, okay, because they have experienced changes in themselves through the product, and that's the best type of salesperson you can get. A person who is not working for money, but rather with results. So that's why I'm so bullish on companies like Medifast. Extremely well, extremely growing company. Now there are some risks because there is only one product, Optavia. There is only most of the revenues produced from that. If something happens or brand name tarnishes, it can really hurt the company. But overall, it's going to do really well. They are coming up with new products, Optavia 2.0, and I think it will do fabulously. This company will do really, really well. USANA. Now, USANA is international play. This company is based in different countries. It's also based in USA, but it's also based in China, which is their biggest market. Also based in Hong Kong, Malaysia, Singapore, and all these countries. Their main selling product is their nutritionals. Nutritionals is basically, vitamin A, vitamin B pills, and stuff like that. Now, they are also multi-level marketing or a networking company kind of thing. But the thing is, the company has no debt, and their book value, mwah, it's fabulous. The company has no debt on its sheets. It basically has a lot of cash on hand, and that is what I'm trying to look. The company has no debt. It's a fabulously run business. They're expanding in different markets. Now, the main thing about USANA is that I don't like is running after so many rabbits. It's going after so many countries. Now it's going after Vietnam. It's going Laos. All these countries, and they're not sticking to one market. They're running after so many markets, so many products. They're now building up protein bars in USA, in somewhere in Massachusetts. They just bought a facility and they're starting to build protein bars over there. So those are the things that I don't like. I think their main product selling is nutritionals, and I think they should focus more on that. Focus more on what's working instead of what's not working. So, but it's also a great business. No debt. Okay, more cash on hand. Extremely more cash on hand. Okay, good book value. Growing. It's growing. It's in the biggest market in the world, and it's growing. Same thing with New Skin Enterprises. Now, New Skin Enterprises is more of like a book value play. The company has the price of the company is same as the book value, and it's also in one of the biggest markets in the world, in China. So, that is also some were like diversified play. They are also selling products like eco-friendly skin products and stuff like that. They also have a multi-level marketing kind of structure. So I bought three multi-level marketing companies to kind of diversify. If something happens to Optavia, I have New Skin to fall back on. If something happens to New Skin, I have USANA to fall back on. So to kind of diversify my profits, and plus I think all three of them are available at cheap prices and they're growing. They're growing rapidly. Followed by Kimball Electronics. Now it is available at a very cheap price, very nicely growing company. So far, I'm up by 5%, but it doesn't really count. I'm looking 3 or 4 years ahead. I think this stock will 3x or 4x easily, based on the earnings per share. Followed by Arrow Financial. Now, Arrow Financial is interesting. Arrow Financial is an upstate New York bank. The thing with this bank is this bank did not miss a dividend payment during the recession in 2008, during the recession in 2002. They have never missed a dividend payment. Their book value is more than the stock price. Okay, if they have to liquefy everything, the bank has to close tomorrow and everything has to go tits up. This bank, it can pay. It can pay whatever it owes, what it can pay the shareholders more money than what I paid it for. So that is amazing. That's why I own it. It's never missed a dividend. The bank is expected to grow by at least 10 to 12% year over year for the next at least 4 to 5 years. If it depends on the interest, everything depends on the interest rates, of course. But banks mainly depend on the interest rate. But they don't. But they make money in any environment. Banks make money. Banks thrive if the interest rates are low. Bank thrives when the interest rates are high. So Arrow Financial, yeah, it's mostly value play, book value, a growing bank, slowly growing, but it is still growing nonetheless. I'm expecting my price to double within the next 5 to 7 years, and the dividend, along with the dividend combined. Next to 5 to 7 years, I'll expect my money to double. Safe harbor for my money. Now, I'm going to be adding more companies to this small cap kind of fund. This is all small cap fund that I've merged on with my big holdings. So I'm going to be adding more money to these companies. I'm going to be adding more companies. Also, some more value plays, which I think are available below their book value or which I think are available at good prices compared to their earnings in the future or the earnings they have been growing in the past. Based on that, I will be adding more companies to this portfolio because some of them will be winners, some of them will be duds. And now, by duds, I mean the earnings will grow nonetheless. I'm not going to pick companies which earnings are not growing because what's the use of it then? The earnings will grow nonetheless, and the book value will be good. But sometimes, around stocks, for 3 years, 4 years, there is no euphoria. Companies are doing good, companies are doing great, but people just don't. People are just focused on something else. Like right now, people are focused mostly on large caps. There are very not a lot of people looking onto small caps, but people are looking nonetheless. But not a lot of people are looking. So when there is less euphoria, the prices of the stock don't jump too high, and it is a good thing and it is a bad thing because you can always find deals over there, but you don't like make your money instantly. You don't double or triple your money instantly. It's something you would do in large caps. But smaller companies, they grow faster, and based on the earnings per share and all that, you double your money through that. You don't double your money through euphoria most of the times, is what I mean to say. So those are the companies that I hold. Very well diversified portfolio, among utilities, telecom, healthcare companies, industries like railway and 3M. 3M is one of my favorite companies. Okay, I hold 3M in here, and I keep buying more and more because I just love the company. It's fabulous business. So companies like that in this portfolio, financials for me has done fabulously well. It's because of the time that I bought it. Again, I keep hammering this point over and over. Main money is made when you buy it at the right time and the right price. I'm not saying time the market, but the right price, buying at the right price is crucial. Financials I bought in November when there was no love, there was nobody showing any love to financials. Everybody was hating on financials. Everybody was like, oh, we're just in a pandemic, banks are going to struggle, banks are going, but I saw their balance sheets, they had so much cash on hand. The management was good for both JP Morgan and Capital One. And on Capital One, I'm almost double my money. If you include the dividend, I've almost, tripled my money within like 10 months, 11 months. Okay, I picked up the stock at $90. Stock is currently trading at $171, and it pays a dividend of 0.88%, and still it's at a p/e of 6.5. I mean, it's a fabulous, fabulous business, and people were just showing not showing any love. My 1700 has turned into $3,400. It's doubled. And people were not showing any love. People didn't show any love to banks. Okay, people were not showing any love. People were scared of banks. And that is the time I was building my positions in banking. And it paid me out really, really well. There was a bank, a small cap. The reason I love small cap so much is because they have done really, really well by me. There was a bank called Sandy Spring Bank, which I bought at around $22 a share, and I kept buying it until $26 to $27 a share, and then I started selling it off at $46 and $47 a share, and I had liquidated everything by the time it was at $45 a share. So within a span of like 3 or 4 months, guys, and also paid me a dividend too. So within a like of $78, so within a span of like 4 to 5 months, I had almost doubled my money. Double my money. Started with almost 8,000 and doubled it to 16,000 plus a dividend of $78. So doubled my money within a span of 3 to 4 months. $8,000 for doing nothing. So it's timing. Timing is really, really crucial. I think the crashes in the future, the market crashes, they're going to get shorter and shorter. Corona crash, very, very small because the government now pumps money. Pumps. I don't know how long they can sustain that, how long they can keep devaluing the currency and keep doing that, but that's yet to see. But the crashes are going to get smaller and smaller and smaller, and the interest rates they cannot. I don't think they will ever raise the interest rates above 4% at least. So the crashes are going to get smaller and smaller. The opportunities in the markets are going to get low and low and low. There'll be barely any opportunities like something like 1929 or 2001 or something like that. There won't be any more any there won't be many opportunities now like that because and the returns are going to get lower and lower. I mean, if you're expecting returns of, let's say, above 5%, 10% in the markets, I think it will be really, really hard because system is changing now. Things are changing, and that is my thinking. That is what I think. The crashes are going to get slower and lower, smaller and smaller. If a market crashes, I think it'll be very, very small for a very, very small period of time. The returns are going to get lower, and in these markets, you have to be a good stock picker. You have to be a good value person. You have to look for good value. You have to look for good businesses. It becomes more than crucial. If you're ETF, if you're a person for ETFs, no blames, no blames at all. But expect average results. Expect results no more than 8%, 10%, 12% annually. Right now they're doing good because the market is jumping high. But overall in the long term, don't expect returns like 40% or 50% a year. If you're a stock picker, it's a different story, and that is my goal. I'm a stock picker. I am looking to buy great businesses, and I am looking to get returns of at least 25 to 30% annually. Now I know that's a big number. Even Warren Buffett couldn't achieve it some years, but we're looking at long-term horizons. We're looking at 5 years, 10 years out, how my portfolio performs. If I can do it, then it means that I am a good portfolio manager. I'm a good stock picker. I'm a good money manager for myself and for my family. But if I cannot do it, then there is, I have to improvise. I have to become a better investor. I have to learn something else. I have to read more books. I have to do something, right? What am I missing? What am I missing? How can I achieve those results? And so that is my mission for this portfolio, is to achieve 24 to 25% return every year, no matter what market I am in. And how am I planning to do that? By buying value businesses at prices whose earnings are growing, at good prices whose earnings are growing, good management, good products. I know the earnings will double or triple in the next year. They have strong book value, low debt, okay, more cash on hand, you know low institutional interest. Okay, institutional interest is also very important because once the institutions start jumping in into a company, they can make the stock move. If, like, for example, like Honest Company is a very good example. Honest Company was trading at $16 a stock, and the institutional ownership was very high. Okay, and when the institutions started seeing red flag and they knew the company was a dud, they knew the company is a loser, it's not going to do anything, they started jumping out. the institution started jumping out, and that's what pushed the price down to $9 right now. Because there are so many people who have sold along the way. In Honest Food Company, the price is now like $9, and it's barely even going up because the business is trash. It's not even profitable, and nobody knows if it's going to be profitable. And they're killing the shareholders. They're liquidating the shareholders like crazy. They have no cash on hand. The only cash on hand they have is by liquidating the shareholders. And plus, they are paying the management like $9 million bonuses for taking the company public, for really achieving no results by liquidating the shareholders. So businesses like that, it just boggles my mind. Like there is trash business like that out there, and people are pumping stocks like this. Oh, it's a good business. It will do. What the hell is going on, man? Look at business. Look at the business. It's trash business. They're killing the business. Okay, it's not profitable in the past 10 years. It started in 2012 actually, and it's not profitable yet. It has always been in scandals. It has always been losing money. Okay, so businesses like that I have to stay away from in this portfolio, and I have to look at value, true value. That can be found by reading 10Ks, 10Qs, listening to calls. Okay, what are the red flags? What is going on actually behind the scenes? Okay, thinking like a true owner of a good business. That is my strategy for this portfolio. Achieving good returns, 25-30% every year, measuring it over time of 5 years, 10 years, buying good businesses, okay, value businesses that will double, quadruple, 10x in the next 5 to 10 years, and being diligent and doing the work that's required to achieve those results. That was my 2 cents. That was my rant about my portfolio, about the mission that I've achieved so far, what I've learned on my journey. I'm sharing that with you so anybody who's listening can learn and, maybe pick up some nuggets that can help them on their journey. That is my mission for this video. Well, thank you guys for listening in. Thank you guys for tuning in. This is a Frugal Investor signing out.